Tokyo at night looks like a civilization that won. Towers of glass and light stretch toward a cloudless sky. Vending machines on every corner, stocked and humming. A bullet train threading through the dark at 300 kilometers per hour, arriving not within a minute of schedule, within a second of it. This is a country that took the rubble of 1945 and built one of the most sophisticated economies in human history. It exported its cars, its culture, its technology, and its philosophy of precision to the rest of the world. Japan did not just recover, it dominated. And so when economists began whispering about debt ratios and demographic cliffs and central bank distortions, the world did the reasonable thing. It looked at Tokyo, looked at the functioning society, looked at the absence of visible crisis, and stopped listening. The bears were wrong in 1990, wrong in 2000, wrong in 2010, wrong in 2020. At some point, being wrong enough times stops looking like a mistake and starts looking like a misunderstanding. Maybe Japan simply operates by different rules, maybe the old models do not apply here. That comfortable conclusion is exactly what makes this so dangerous, because Japan is not evidence that debt does not matter. Japan is evidence of how long a system can be held together by institutional willpower, financial repression, and the slow, invisible taxation of an entire population's savings before the internal pressure exceeds the containment. The neon is real. The trains are real. The illusion is real too. And like all illusions, it does not break the moment someone sees through it. It breaks the moment everyone does, simultaneously, with no warning and no orderly exit. Every student of economics learns the same rough heuristic early. When a country's debt exceeds its annual economic output, the warning lights turn on. When it approaches 150%, serious people start using words like unsustainable. Japan's gross government debt now sits at approximately 250% of GDP. There is no comparable precedent among major developed economies in peacetime history. This is not a worrying number. It is a number that, by every conventional model, should have already triggered a sovereign debt crisis, a currency collapse, or both. It has not. And that requires explanation. Part of the answer lies in who holds the debt. Unlike Greece, which owed money to foreign creditors who could withdraw at any moment, Japan's debt is overwhelmingly held domestically, by its own banks, its own pension funds, and increasingly by the Bank of Japan itself. A country that owes money primarily to its own citizens and its own central bank operates under different short-term dynamics. There is no foreign creditor to panic and pull the plug. The system can be, for a time, self-contained. But self-contained is not the same as solvent. It is the same as sealed. And a sealed system under pressure does not bleed slowly. It holds, and holds, and holds, until it doesn't. The other part of the answer is interest rates held artificially near zero for 3 decades, which means the carrying cost of all that debt remains. For now, manageable. Change that one variable, raise rates to even modest historical norms, and Japan's interest payments alone would consume a staggering share of all government revenue. The math does not work. It has never worked. The only reason it appears to work is that the system has been specifically engineered to prevent the math from being tested. In a functioning bond market, the price is set by the tension between buyers and sellers. Investors assess risk, demand appropriate yield, and the market discovers what government debt is actually worth. It is an imperfect mechanism, but it is a real one. It carries information. It sends signals. It imposes discipline on governments that spend beyond their means by making borrowing more expensive. Japan no longer has that mechanism. What it has instead is the Bank of Japan. The Bank of Japan now owns more than half of all Japanese government bonds outstanding. In certain segments of the market, it owns everything effectively. It does not buy these bonds because they represent a sound investment. It buys them because if it stops buying, yields rise, the government's interest burden becomes unserviceable, and the entire fiscal architecture collapses. The Bank of Japan is not a central bank operating monetary policy in any traditional sense. It is a financial life support system, and the patient cannot be disconnected. What this has done to the market itself is profound and underappreciated. Price discovery is gone. The signal that a bond market normally sends, this government is borrowing recklessly, here is the cost, has been permanently jammed. Foreign investors largely exited years ago, recognizing there was no genuine market left to participate in. What remains is a closed loop. The government spends, issues bonds, the central bank creates money and buys those bonds, and the government spends again. It is a perpetual motion machine that violates the first law of thermodynamics. Energy is being consumed somewhere. That somewhere is the purchasing power of every person holding yen. The free market for Japanese government debt did not crash. It was quietly, methodically eaten alive. Every economy runs on a fundamental ratio, the number of people producing relative to the number of people consuming. Workers generate output, pay taxes, fund pension systems, and drive demand. Retirees draw down what was accumulated. The ratio has to remain roughly functional, or the arithmetic of social contracts begins to break down. Japan's ratio has been deteriorating for decades, and it is now approaching something that demographers struggle to describe without reaching for words like catastrophic. Japan has one of the oldest populations on Earth and one of the lowest birth rates among developed nations. For every person entering the workforce today, the system is supporting a growing number of retirees drawing pensions, consuming healthcare, and no longer contributing to the tax base that funds those obligations. The working age population has been shrinking in absolute terms. There are entire rural prefectures where the school buildings have been converted to elder care facilities because there are no longer enough children to fill them. This is not a future problem, it is a present one, compounding quietly every year. The fiscal consequence is direct and brutal. Pension obligations grow, healthcare expenditure grows. The revenue base required to service both shrinks. The government fills the gap with more borrowing, which requires more bond issuance, which requires the Bank of Japan to purchase more of that issuance, which requires more money creation, which erodes the currency further. The demographic crisis does not sit beside the debt crisis. It feeds it, continuously, structurally, without any political solution capable of reversing it within a relevant time horizon. Immigration, the release valve that other aging nations have reached for, remains largely politically foreclosed in Japan. The spiral has no obvious exit. In a healthy economy, failure is a feature. Companies that cannot compete, cannot innovate, and cannot service their debts are supposed to exit the market. Their assets get repurchased by more productive enterprises. Their employees find better roles elsewhere. Capital reallocates toward its highest use. It is a process that is uncomfortable in the short term and essential in the long term. It is how economies renew themselves. Japan turned off that process 30 years ago and never turned it back on. When the Bank of Japan suppressed interest rates to near zero and held them there, it inadvertently created a permanent subsidy for failure. Companies that should have gone bankrupt in 1995 could borrow at essentially no cost and keep operating indefinitely. Banks, sitting on mountains of bad loans they refused to write off, extended and pretended, rolling over debt that would never be repaid, rather than recognizing losses that would have destroyed their balance sheets. The Japanese government, terrified of unemployment statistics, quietly encouraged this arrangement. Keep the companies alive, keep the workers nominally employed, keep the numbers presentable. The result is an economy riddled with what economists now call zombie corporations, businesses generating insufficient revenue to cover even the interest on their debts under normal conditions, surviving purely because normal conditions have been abolished. Estimates suggest that a significant portion of Japanese listed companies fall into this category. They consume capital, suppress wages in their sectors, crowd out the innovative competitors who might otherwise replace them, and collectively represent a massive deadweight dragging on the productive capacity of the economy. The moment interest rates normalize, even partially, the zombie population faces extinction, and the banks holding their worthless debt face it alongside them. There is a slow way to steal from a population and a fast way. The fast way involves obvious confiscation, and populations tend to notice and resist it. The slow way involves currency debasement, the quiet, technical reduction of what each unit of money can actually purchase. It requires no legislation, no enforcement, and no announcement. It happens in the background, and by the time most people understand what has occurred, the transfer of wealth is already complete. The yen has lost approximately 30 to 40% of its value against major currencies since 2021 alone. against the dollar, against the euro, against hard assets, the yen has been in persistent structural decline. For ordinary Japanese citizens, this means that the cost of imported energy, food, and goods has risen significantly faster than wages. The savings that an aging population spent decades accumulating quietly purchased less each year. No one broke into the vault. The vault was simply made of material that dissolves in water, and it has been raining. The Bank of Japan's response to yen depreciation has been constrained to near paralysis. A central bank watching its currency collapse would normally raise interest rates to make that currency more attractive to hold. But Japan cannot raise interest rates without triggering the sovereign debt and zombie corporate catastrophes described in every chapter prior. So it watches. It intervenes occasionally in currency markets, spending foreign reserves to buy yen and slow the decline, buying time measured in weeks. It cannot buy the yen's structural problem. That problem is the logical consequence of every policy choice Japan has made for 30 years, arriving at the exchange rate like a creditor who has been patient long enough. This is the chapter where the trap becomes visible. Everything prior, the debt, the demographics, the zombies, the currency, feeds into a single, elegant, inescapable mechanism that has cornered the Bank of Japan as completely as any institution in the history of modern finance. The Bank of Japan controls what is called yield curve control. It does not merely set short-term interest rates, as most central banks do. It directly caps long-term bond yields, committing to buy unlimited quantities of government bonds to prevent yields from rising above a specified ceiling. The policy was designed to keep borrowing costs low and stimulate an economy that had been stagnant for decades. What it actually did was hand the bond market a loaded weapon and then handcuff the central bank. Here is the impossible choice in its clearest form. If the Bank of Japan abandons yield curve control and allows rates to rise, Japanese government bond yields normalize towards something resembling global reality. The government's interest payments explode. A significant portion of the budget goes entirely to debt service. The zombie corporations begin defaulting. The banks holding their debt report catastrophic losses. A domestic financial crisis unfolds with extraordinary speed. If the Bank of Japan maintains yield curve control, it must continue purchasing bonds at whatever scale the market demands, which means continuing to create yen, which means continuing to debase the currency, which means the yen continues its structural decline, which means imported inflation continues destroying the purchasing power of every Japanese citizen. Defending the yield cap and destroying the currency are not two separate policies. They are the same policy viewed from opposite sides of the same wall. There is no option that does not cause severe damage. There is only a choice about where the damage falls and when. Here is where the story stops being about Japan. Japanese investors are not passive domestic savers sitting quietly in yen-denominated accounts. Decades of near-zero domestic returns drove enormous capital flows outward, into foreign bonds, foreign equities, foreign real estate, as Japanese institutions searched globally for any yield at all. Japan has accumulated what is believed to be the largest net foreign asset position of any nation on Earth. Japanese pension funds, insurance companies, and individual investors hold trillions of dollars in US treasuries, European bonds, Australian assets, and global equity markets. This capital did not leave quietly. It became structurally embedded in asset prices worldwide, which means that when the Japanese system finally fractures, when the internal pressure exceeds the containment, the damage does not stay inside the seawall. A yen collapse or a domestic financial crisis forces Japanese institutions to repatriate capital. Pension funds covering their domestic losses liquidate foreign holdings. Insurance companies facing yen-denominated claims sell dollar-denominated assets to raise currency. The US Treasury market, already absorbing enormous issuance of its own, suddenly faces one of its largest foreign holders selling at scale, not for strategic reasons but out of simple necessity. Yields spike. Global borrowing costs rise. Asset markets price in a new reality across every geography simultaneously. This is not a theoretical transmission mechanism constructed to frighten. It is the direct mechanical consequence of how deeply Japan's capital is woven into global markets. Japan's crisis does not end at its borders. It arrives at everyone else's borders, carrying the accumulated weight of 30 years of exported capital. all of it now suddenly needing to come home. Every complex system has a threshold, a point where the stress applied exceeds the structural capacity to absorb it, and what was a managed deterioration becomes an unmanaged break. Engineers call it a failure mode. Physicists call it a phase transition. What it looks like from the inside is, one morning, the rules that governed yesterday no longer apply today, and there is no orderly process for discovering what the new rules are. Japan's threshold arrives the moment the bond market stops believing the Bank of Japan can hold the line. It may begin with inflation, genuine, imported, structural inflation, that forces the Bank of Japan to choose between the yield cap and the currency, with insufficient runway to manage either. It may begin with a failed bond auction, a moment of illiquidity in a market that has been rendered entirely artificial. It may begin in the foreign exchange market, with a yen move so violent it creates margin calls across the global carry trade, the vast institutional practice of borrowing in cheap yen and investing in higher yielding assets elsewhere, forcing simultaneous liquidations across every asset class in every market. When it begins, it compounds faster than policy can respond. Rate expectations reprice globally within hours. Japanese bank stocks collapse. The government announces emergency measures that require emergency financing, which requires bond issuance that requires the central bank to purchase that issuance at a pace that accelerates the currency collapse it was already trying to slow. Each intervention creates the conditions demanding the next intervention. The loop closes, and the world, which had spent 30 years watching Japan and concluding that debt simply does not matter if you control your own currency, discovers what was actually being demonstrated. How long you can run before the cliff's edge finds you. Japan is not a cautionary tale about a distant country making exotic mistakes. Japan is a preview. It is what happens when a developed economy, with an aging population, a political system optimized for short-term stability over long-term solvency, and a central bank willing to purchase its own government's debt without limit runs that experiment to its logical conclusion. The United States, the United Kingdom, and the European Union are running variations of the same experiment at earlier stages, with younger demographics buying additional time and a global reserve currency providing additional insulation. The buffer is real. It is not permanent. The uncomfortable truth that Japan forces into visibility is that no institution, regardless of how sophisticated, can permanently repeal the basic relationship between debt, money, and value. The Bank of Japan did not discover a loophole in economic gravity. It discovered how long gravity can be defied before it reasserts itself, and the answer, it turns out, is long enough that everyone stops believing it will. For the investor watching this, the question is not whether to be alarmed. The question is what alarm, rationally translated into action, actually looks like. Hard assets, geographic diversification, reduced exposure to long-duration government bonds across all heavily indebted sovereigns, an honest accounting of what counterparty risk means when the counterparty is a central bank that has spent its credibility. Japan is not the bomb going off. Japan is the sound that precedes it, the kind that only makes sense after the fact, when everyone recalls that they heard it and chose to assume it was something else. The question is whether you hear it now while the choice is still yours to make. If you are the kind of person who would rather know than not know, subscribe. Every piece of content on this channel operates from the same premise. The most dangerous financial risks are the ones that look boring until the moment they don't. Share this with one person who still believes sovereign debt is someone else's problem, not to frighten them. Because informed people make better decisions, and better decisions compound over time, just as reliably as the crises we just walked through.